Stel je kunt goed rekenen en regelen. En je wilt je hypotheeklast zo laag mogelijk houden. Dan heb je geen zin in advieskosten. En omdat je alles zelf regelt, wil je maandelijks een scherpe rente. Dat snappen we. Daarom is het de MoneyU internethypotheek. Die je van advies tot akte helemaal zelf regelt en afsluit. MoneyU, geen gedoe.
Zaterdag 25 april dragen we onze vrijwilligers op handen. Kom naar Zwolle en vier het festival van stichtingen en verenigingen. Lang leven de club, kijk op thermosjacoinpark.nl.
De visie is veel tijdens het proces zelf denken. Ja, maar goed, nee.
Ja, dus ook nog heel erg gereguleerd, de nieuwsvoorziening. Ja.
Dus we teach, toen ook voor waarschuwing. En sindsdien is zijn reputatie onomstreden. Over Griekenland, over het aanzetten van de geldpers in Europa, over een nieuwe mogelijke crisis. James Grant, welkom.
Okay. President, where is the president of president? Okay, just before we start with our case study, I just show you something about international finance. It was yesterday. You want to ask a question? No, it was yesterday on the Dutch television, so when you were making a paper, I was watching TV. But it's an interesting part, I think. Okay, so it's not that you need to agree with everything. But of course, he is American, so he's a little bit naive, but nevertheless, let's have a look. So just a short introduction of this afternoon. So again, it's, Mickey Mouse is there again. Okay, so it's James Grant, and it's a famous person on Wall Street. So let's listen. But of course, first I need to. Mr. Lightman. Yeah, let's do it like this, and it's also working.
Thank you, we're very pleased to be here. Pleased to have you here. Now, it's called, your magazine is called Grant's Interest Rate.
Zaterdag 25 april dragen we onze vrijwilligers op handen. Kom naar Zwolle en vier het festival van stichtingen en verenigingen. Lang leven de club, kijk op thermosjacoinpark.nl.
Bij veel mooie dingen die je wilt, weet je dat je niet de eerste bent. Toch? Daarom verkoopt die refurbished Apple-apparatuur met 12 maanden garantie. Online en in onze winkels. Je hebt al een MacBook voor €399. Bij die.nl.
Interest Rate Observer. These rates are
over, maar die Silverman, als er zo'n ongeluk
actief op Wall Street.
commenteert en die heeft het laten zien wat er dan gebeurt als er zo'n ongeluk gebeurt in een wereld waarin er geen internet is om het heel snel te delen. Van ouders die bij de trein gingen staan op hun kind te wachten. Ik dacht, mijn kind komt zo aan, ik kom zo van het vliegveld. Maar ook altijd publieke rouwbetoon, wat je nu ziet via Twitter en Facebook. Dat iedereen kan meekijken en inzoomen, live, real-time, met allerlei internetverbindingen, met hoe er gerouwd werd. Allemaal niet, was er allemaal niet. Was ook nog de DDR, dus het was natuurlijk ook nog heel erg gereguleerd, de nieuwsvoorziening. Maar ja, het was een berichtje in de krant en dat was het. En daarmee was het klaar eigenlijk. En het verdriet was er niet minder om, maar het komt nu pas in de krant 28 jaar later.
Dankjewel. Shaila Sittelsen. Hij is een icoon in de wereld van de financiële markt. De Amerikaan James Grant, al meer dan 30 jaar actief op Wall Street, uitgever van het tweemaandelijks blad voor investeerders Grant's Interest Rate Observer, connoisseur, enfant terrible, vlijmscherp criticus, geliefd bij de belegger en gehaat door centrale bankiers als Ben Bernanke, Janet Yellen en Mario Draghi. Een van de weinigen die de grote crisis in 2008 zag aankomen en daar toen ook voor waarschuwde. En sindsdien is zijn reputatie onomstreden. Over Griekenland, over het aanzetten van de geldpers in Europa en over een nieuwe mogelijke crisis. James Grant, welcome.
Thank you, Professor. Nice to be here.
Pleased to have you here. Now, it's called, your magazine is called Grant's Interest Rate Observer. These rates are so terribly low.
You can't see them anymore.
No.
Yes, I have problems with my business model. One can't see them there. Some of them are less than zero. So I must rethink this.
Okay, we'll talk about that. Just trying to get to know you better. You're a financial journalist.
I am.
You're a financial historian.
Yes, I confess to both.
And you're also an investor.
I am.
So you put your money where your mouth is.
Yes. Why shouldn't I?
Well, I don't
It
know.
would seem insincere if I didn't invest in something I believed in. So yes, I do.
You do
I
that.
with full disclosure to my audience, my far-flung audience.
Okay. And what maybe is so special about you and your magazine is that history plays a large role. What does history teach you?
Well, history teaches us to be surprised less. It can't teach us exactly what's going to happen. After all, historians proverbially are not rich as a class of persons. But what history can do is to remind you that certain things in human affairs are recurrent, and that people with money often do things that they ought not to do.
Yeah.
People seem insistent upon buying high and selling low, and actually, one ought to buy low and sell high. That's my reading of history.
And did you already find out why people are so persistent and why they make the same mistake over and over again?
Well, the Russians have a folk expression, stepping on the same rake. And the rake in question is one of emotion, really. When things are going up, everyone is happy and one is carried along with the crowd. Optimism is contagious. But as things go up, they become less value-laden. They become less desirable as investments. So paradoxically, the better one feels about something in investing, the riskier it is likely to be. And equally paradoxically, the more despondent one feels about a certain class of asset, the more attractive it is with regard to value. So one ought to be euphoric at the bottom and despondent at the top, when actually one is the opposite.
Okay, so at this moment we should invest in maybe Russian assets, or?
Well, I'm not going to prescribe investing for the audience, but if you ask me what I'm doing, I have been buying some Russian stocks, in particular a Russian bank that happens to be very well managed. Alas, it lives in Russia and is regarded by the world as highly undesirable for that very reason, but the bank in question is Sberbank. And it is one of the better managed banks in all the world, but it is priced as if it were going broke. I think it is not going broke.
No one wants it.
No.
But you do.
I do. I bought a great deal of it for me, not for the world, but in December.
Now looking back at the crisis, but maybe we haven't overcome yet fully, you seem to have, you saw it coming.
I did.
What was your secret then in 2006 or 7?
The secret was to read the newspapers. House prices were in orbit. Debt was being mispriced, meaning that anybody with a pulse, proverbially, could get a loan for a house, for equities, stocks, to buy a company, called private equity. Money was for free, as it were. One could raise loans with next to nothing in the way of bona fides with respect to credit. So that told me that things were getting very dangerous, and I sometimes I felt as if I were going crazy because the rest of the world was more or less insistent that things were just perfect. And among those people were the central bankers and the powers on high.
You saw it, and no one else saw it.
Well, some did. I was far from alone. But grants, interest rate observer, yes, we did see it.
If you compare the situation then to the situation now, also at this moment there's a warning from IMF saying there's an illusion of liquidity. People are, again, investors are borrowing money to buy shares. Do you recognize something?
Well, sure. Mario Draghi is fond of saying that we are in uncharted waters with respect to Greece. That's his point of reference. We are in all too familiar waters, all too well charted with regard to the mispricing of many investment assets owing to the manipulations of our central bankers. So some of this is familiar and some of this is new. New, for example, is the level of interest rates. In the Netherlands, we have records going back into the late 1500s. Never have rates been so low since the late 1500s.
Here's the historian speaking.
Yes, authoritatively. I read that someplace. So in some respects, we are, I think, in a riskier place today than we were in 2006. You know, once we had the gold standard in money, and today we have the PhD standard. We are in thrall to former tenured academics. And never before in the history of finance have so many college professors exerted so much power and influence.
Okay, so you'd rather have the gold standard back?
I would indeed.
I think it was in the 70s that we left it, didn't we?
We did.
Yeah, and that was
precipitously.
Yeah. What happened exactly to refresh our minds?
Well, America promised too much and had too little in the way to back up those promises. America insisted upon waging a war in Vietnam, upon spending a great deal of money on what President Johnson was pleased to call the Great Society. And we emitted dollars into the world, much as Mario Draghi is producing euros today. However, the difference then was that we had undertaken to redeem those dollars with gold at a fixed price. So the Bank of the Netherlands, the Bank of France could and sometimes did come to the United States Treasury and say, here are my greenbacks, these pieces of paper. I would rather please give me gold, which you have promised to pay me. $35 for an ounce. Now it's, of course, $1,200 an ounce. But the gold standard checked the power of governments to expand money and to inflate it.
And since we left it?
Well, there's been a great deal of credit, a great deal of money printing. And in the past several years, we have embarked on a truly unique experiment in money printing.
Yeah, because there's now something called QE.
Ah, yes.
Quantitative easing?
Yes. What does that mean exactly, by the way? Oh, yes.
I don't know. Do you?
I've been studying the situation. Some years ago, there's a wonderful letter to the editor in the Financial Times of London, and the correspondent said, "Dear sir, I think at long last I understand the meaning of the phrase quantitative easing, which means money printing. However, I no longer seem to understand the meaning of the word money." Now, a couple of days, April 15th, I think, Mario Draghi was giving a briefing to the press, and there ensued this commotion. A woman leapt up on the rostrum and showered him with what the press called glitter. I like to think that it was confetti, and the confetti was symbolic of the euro, and of the dollar, and of the yen, and of these currencies which can be manipulated and can be materialized from nothing. They are non-corporeal. They exist on a computer hard drive or in the cloud.
And this is what you're very worried about putting on the money machine, making money, not covered by gold or anything else.
Well, money used to be, and it seems to me ought to be, it's a judgment, but it seems to me ought to be a weight or a measure. We don't go adjusting scales and measuring rods and rulers because we are dissatisfied with the length of a piece of paper. We hew to
But can you
standard.
I understand, but can you explain what exactly is at this moment, for instance, for the average man in the street, the dark side of this QE?
Well, the dark side is to come, although some of it is now visible. What we see now is the ostensible sunshine. We see, for example, if you are a company in Europe and want to raise money, you can borrow, even if you are speculative grade, or as they say, junk grade, you can borrow at an interest rate beginning with the number 3. Never before heard of. Extraordinary. Now, that's good, right? Because more investment, more borrowing means more investment, more jobs, I guess, right? That's what they say. Except if the interest rate is the government imposed one rather than one that is discovered in the open market, it's likely that it is an artificial rate. Now, interest rates are important because they are the traffic signals of a market economy. They can't all be green, otherwise we'd have innumerable crack-ups, intersections, right? It'd be a terrific chaos. So what central banks the world over are doing is to press down interest rates and to artificially inflate credit, meaning borrowing debt.
Yeah.
And so what has happened so far is a lot of pretend and a lot of easy money. Some people think that's good. Stock markets are highs, right? It's a lot of confidence around among people who hold assets.
But it's too easy, this money.
Yes,
That's what you're saying.
yes. If it were that easy, wouldn't we all have been much richer many hundreds of years ago if it were this easy to make money free?
Yeah. What would you have done if you were Mario Draghi?
I resigned. Because he is undertaking to act in the role of a central planner. What this central banking is a species of central planning. It's command and control. It reminds me a little bit of Poland, 1957. Right? What they do is to say, all right, we have consulted our econometric models. You wouldn't understand them, you ordinary mortals, but we have consulted our, and we deem it necessary to press down interest rates and to make credit prolific and to sprinkle all of the continent of Europe with these colored pieces of paper that we call euros.
I understand what you're saying, but resigning is maybe too easy for Draghi.
So I have to stay?
You have to stay, you have to do something. What would you do?
I would say, ladies and gentlemen of the jury of the public, let us reconsider the road we are traveling on. Let us move away from command and control to a market-oriented financial system in which, by the way, capitalists earn the profits and also bear the losses. Right now we have a system which is neither capitalist nor exactly socialist. It's a species of financial socialism in which the great and the good get to keep the dividends and the taxpayers get to bear and help to bear the losses. This wasn't the way it was meant to be.
So we should start with not saving banks anymore.
Yes, we should let the stockholders pay the freight of a failed bank. Now, this was the way it worked until, in my country, until not so very long ago. I dare say it worked in the continent of Europe the same way. So the stockholders would get a capital call, meaning they would be required to stump up more funds in the event the bank in which they were a fractional investor became impaired or insolvent. Now, that went the way of the black and white television set. But isn't that a more equitable way of proceeding than to say, all right, the banks have failed, too bad, now you taxpayers will bear the freight.
But do you want to leave everything to the market?
Pretty much.
Markets are hysterical too sometimes.
They are. They are less hysterical when they are allowed to function and when people who have to bear losses are allowed to bear them. What makes markets especially unhinged and hysterical is the knowledge that in the event of a crisis, the government will be there to help out the people with money. We live not in the Garden of Eden, but in the land of the fallen human being, and no human institution is perfect. And markets certainly leave much to be desired. But given the choice between a command and control regime managed by non-elected, former tenured college professors on the one hand versus a decentralized, market-driven, individualist regime on the other, give me the latter.
Let's turn to Greece, Mr. Grant. There's this weekend another IMF meeting. Greece is once again on the agenda. There's uncertainty. Greece is going to pay back its debts. Troika demands a detailed plan. Greek government is not willing to pursue the austerity program. So it seems to be a stalemate. Who's going to blink first?
No. I mean, as seen from New York City as opposed to Athens, what I see is two forces at work. One is arithmetic, and the arithmetic doesn't work. Right? So That's the truism I will leave with you with respect to the finances. Greece owes more than it conceivably could pay. Although it's been given all manner of opportunity to push this out into the distant future. And there's the other item at work is ideology. Now, a few days ago, there was a protest. People marched in Athens, 4,000 people, the press said, to protest against the government's refusal to consider the relicensing of an El Dorado gold mine in the north of Greece. 4,000 people, miners and others, saying that we want the dignity of work. The government says, nope. This is a foreign company. It is not passed muster with respect to this and that requirement of the government of Greece, and we, the government, would rather not have them in the country. Well, there are 4,000 jobs right there, or so. So the government of Greece is an extreme leftist regime. It's a coalition, an uncertain coalition. So how does this work out? I have no idea. What I do think is going to happen is that the creditors will be disappointed. The Eurozone in toto owns has lent 300 billion euros or thereabouts. The money's not going to be paid back. Somebody must wear, as they say in Wall Street, must wear the loss. Who? Well, France is on the hook for 70 billion, Italy for 60-odd billion. I'm not sure if that has sunk in to the taxpayers of France and Italy.
And the Netherlands also
substantial. Yeah, I mean, so I speak as a New Yorker rather than authority on Greece, but it seems to me it is one heck of a situation. But it is the least of the problems of Europe.
Is it?
Yes, because the greatest problem of Europe is the monetary system in place. It is the system in which there is a considered and a systematic mispricing of financial assets in the service, they say, of financial recovery.
Yes, and that's what we discussed before. But if there would be a fallout of Greece, what would it mean for the Eurozone in your view? You say it's the least of the problems for Europe.
What this could be, if Greece is allowed to go, if Greece must go, if it's all right, buy Greece, that means suddenly there's a new idea in the world. And the new idea is that you don't have to be in the Eurozone if you had originally been in the Eurozone.
You can leave.
Yeah, you can leave. So Spain, there's a new political idea in Spain. The Podemos party came from nowhere a year ago, and now it is all manner of excitement, and people want to know more about these ideas. Well, these ideas are age-old. They are ideas of a socialist society. Spain might be the next one to reconsider its membership in the euro.
This consciousness, this knowledge of maybe the possibility to leave for Greece, for Spain, what does it mean to financial markets? What does it mean for the Eurozone?
See, I think what Lehman Brothers, what the catastrophe of Lehman told us in 2008 was that problems deemed to be contained by the authorities are often not contained. Right? There are repercussions to financial discontinuities, to these accidents. Actually, they're not accidents, they're crises. But one can't be complacent in the face of the possibility of Greece leaving and of that exit informing others and putting into the world a new idea. This idea could have consequences. Now, to connect the mispricing of interest rates with Greece, nothing is priced in the Eurozone except for Greece for a crisis. All these other countries have debt in the marketplace, and they bear interest rates of sometimes zero, sometimes a little bit more than zero, sometimes a little bit less, which, by the way, is quite extraordinary. So central banks have, as it were, have intoxicated or have medicated people into thinking that everything is going to be lowered. Everything is not going to be lowered.
And in the last minute of our interview, what is the cure?
I think the cure is a return to something resembling the free and open setting or discovery of prices in the marketplace, and an end to government manipulation of not only interest rates, but of stocks and bonds.
And this financial system that we are in, and that is distorted, as you say, by interfering, by central banks, by governments. How long is this financial system going to hold out?
Well, I have said it would end in 2002.
Oh, so.
Well, these things do go on, and I am out of the business of predicting when it will all end. But you don't have to know when it's going to end. You have to look around, and you have to look for mispriced. If you're an investor, you look around for mispriced things, for things that are too cheap or too rich. You don't have to have a date. One can't have a date. The central bankers believe they can know the future. They can't, and neither can we.
Thank you very much.
You're entirely welcome.
Thank you. James Grant aan het einde van Buitenhof. Heel graag tot volgende week. Prettige zondag.
Mr. Light. Okay, so that was yesterday on the Dutch television. Okay, so about Greece and Spain. Is Spain going to leave after Greece?
I don't know.
Yes?
No, she will come here.
It's not about your girlfriend.
I'm not going
So this was not about your. So this discussion was not about your girlfriend. It was about economy. So he's really confused at the higher level. President, can you give me a picture of this girlfriend? Because I think.
I hope you allow me to
Okay, so let's, I give a copy to you. Huh? Let's now summarize everything. I mean, let's show that those 5, 1, 2, 3, 4, 5 strategies are very clear to you, okay? How does it work? I just put. No? So first of all, you need to add something. Because especially for you, so you have A, B, C, D, yeah, but you need to add this strategy. So, so the 5th one, and that is buying, participating forward, okay, and the guaranteed rates is $1 is 85 euro cents. The participation coefficient is 100%. So the PC participate, and the central rate is 45 euro. So if the spot rate at T1 is under the 55, okay, then you participate, okay? So guaranteed rate, $1 is 85 euro cents, participation coefficient is 100%, and the central rate is 45 euro cents, okay? Is this clear? So, if we look to central rates, so if we look to the situation, okay, so at T0, so it's all in the same year, okay, so the same period. So at the beginning of the year, you produce 3,000 units of ABC, and you sell those 3,000 units to a client in Switzerland. As you know, in Switzerland, they have still the Swiss franc and not the euro, okay? So you sell them to a client in Switzerland, and again the price is 20 Swiss francs for 1 unit, okay? And the payment is the 1st of May, okay? So 4 months later. So the production is at T0 and your labor cost is 5,000 euro, and you also use commodities, but the commodities you need to pay them in dollars, $10,000, okay? And at T0 you don't have the money to buy dollars. You only need to pay the dollars, okay, the 1st of August. And again, you are going to buy the dollars the 1st of August, okay? It's not that you buy them at T0 and that you keep them and that you, no, there is no money at T0 to buy $10,000, okay? You only need to pay them at T2, and again, you only buy them at T2, okay? But you want to hedge, so you have to, because you are a euro company, so you have, you see, you have two risks. You have the risk of the Swiss franc, and you have the dollar risk, okay? And you don't like currency risks. So you have hedging. And first of all, you have the problem of the Swiss franc, okay? Again, you are going to receive from your client the Swiss francs the 1st of May. But you decided, you keep it very simple, you decided at T0 to sell a forward on 60,000 Swiss francs. So it means you have the obligation to sell Swiss francs, okay, with expiration T1, that's the 1st of May, and the forward rate at T0, at the moment that you sell the forward rate is 1 Swiss francs is 50 euro cents, okay? So that's the story about the Swiss franc. Okay? Then the next, because you need to pay, so you receive, at T1 you receive the Swiss francs, at T2 you need to pay $10,000, okay? And you also don't like the dollar risk. So what you have in mind is, it's all at T0, the first strategy that you consider is do nothing, okay? So no hedge for the dollar. And again, you know from our discussion this morning that if there is no hedge, then you need to buy the dollar at the spot rate at T2, okay? Second strategy, that is buy a forward on $10,000, okay? So expiration is at T2, and the forward rate at T0 is $1.75, okay? Strategy C, buying a European coal, okay? So that must be a European coal on $10,000, expiration at T2. The exercise price is that you can, so then you have the right to buy $1 for 80 euro cents, okay? And the option premium is 600 euro, okay? D, again, it is buying a range forward, okay? So at T0, you buy the same European coal, but together with selling a European put, okay? But again, you do both at T0, not one of them, and no, you buy the coal and you sell the put at T0. So in other words, if you combine this, this is buying a range forward, okay? So that's D, and then, an addition, especially for you, another strategy, at T0 you buy a participating forward with guaranteed rate. $1 is 85 euro cents, so you never pay more than the 85. But if the rate is going down under the central rate, okay, you pay less, and the participation coefficient is 100%. So you have five possible strategies, okay? So what's now the question? That is, calculate the profit in euro of this transaction, okay? So you sell those units to a client in Switzerland, you need to pay the commodities in dollar, so calculate the overall result of this deal in euros, given the hedge that you use for Swiss francs, and given the four possible hedge strategies for the dollar, under two assumptions, that is that the spot rate at T2 for the dollar is 1.1, or that the spot rate for the dollar is only 30 euro cents, okay? So to be clear, maybe what I'm going to do is, I put here, so I'm going to clean this part. So what is expected from you, to be clear, so then maybe I put here the so the okay, so this is the equation, not more than but sometimes less, and less is based on this equation. Okay? So what is again what is expected from you, and again if you can, so if you can construct that table, you show that in fact you don't need to study anymore. So yeah, you need to make this table. So here you have so in that direction you have the different strategies for the dollar. Because again, for the Swiss franc, so it's just what? No choice, just one strategy. Okay. So strategy for the dollar, you have A, B, okay, and here you have the first assumption. So the first assumption is that the spot rate at T2 is $1 is €1. Okay? And then you have your sales. Okay? So your sales are in Swiss franc, but hedged at the forward rate. So that's a plus, of course. Minus operational costs. That's rather simple. That's your labor cost. Maybe I put here, so then there is no discussion possible. Labor cost. Okay? And then the cost of your commodities. Okay? So sales in euros, labor costs in euros, and the cost of your commodities also in euros, okay? And if you need to pay a premium for your hedge strategy, you must include that in the cost of your commodities, okay? So if you do accounting, you are not going, so that's a financial, but here, okay, everything related to the dollar, we put it in the commodity cost, okay? Also the, is this clear? So of course you must make this table in euro, because that's where it's all about, okay? And then we start again, then we have the spot rate at T2 is not 1.1, but the dollar is 30 euro cents. And then you have sales minus labor cost minus commodity cost and again profit. Or maybe you lose money, okay? Is this clear? So you need, so the period T0, T2, we put it all in the same income statement. Everything in euros, based on the strategy that we use to hedge the currency, and so on. Is the question clear? Crystal clear? Questions about the question? Again, so just solve it, okay? Again, if you can solve this, it means that everything is under control. And again, based on our discussion of this morning, it's possible to, you don't need additional readings and so on. If the story of this morning was clear, it must be able to solve this. Okay, just do it, and of course work together with your neighbor, because the challenge is, or the objective is, that if it's not completely clear to you, that someone else, by discussion, that you come to the right solution and conclusion. Who is going to work together with Italy? maybe Brazil, join Italy. Okay? And can you replace, because his girlfriend is not here, so play his girlfriend for the next hour? Allee, then, for this case, eh? Don't be afraid, I will closely watch him. No, but work together, so that's part of the learning process. Okay? And again, everything related to the dollar, everything in commodity cost. Okay, so but again, if you know accounting, you're not going to put the premium of the option in the commodity cost, but here it's finance. We just put everything in the.
This guy will pay him 2,000. He has several options, right?
Yes, because I'm sorry, yeah, that's forward. It's an obligation to buy or sell something. So he doesn't have an option. So what we have to do is just not flexible, but that's yeah, so for sure
Let's put forward.
yeah.
The forward and the application.
So
Yeah, he will have to buy this contract. He will have to buy. He will have to. He will clients. He will receive.
he will receive
60,000.
no, that's so you will receive
He will convert.
yeah, but in euros you will yeah.
if you converting it. Yeah, but he received it.
Again, your table, that's the income statement for the company in the period T0, T2, okay? Everything in euros. And in the income statement, you don't take time value of money into account. Eh? €1 at the beginning of the period is the same as 1 at the end, okay? So, like you make an income statement for accounting.
No, okay.
What happened? Don't like that.
That's what you thought. For sales, we divide it. Yeah, so it would be 30, right? I don't think so, because this is the only you do nothing here.
Yeah, but it sounds easy. I think so. Yeah. So in that case, it's always a forward. Now, property is consider the labor is minus 1,000 and then yeah, then we have 50,000. Yeah, here. Now, if we do the same cost, now but apply for contract, let's see the mix. You should expect.
This sales. Because sales is
yeah, we probably say what is that?
Because now they only change the VAT on
the labor cost is 5,000 euros.
then they only change the rate.
Yeah, but do nothing, it's only for the dollar. Again, the do nothing strategy is only related to the dollar. Eh? The Swiss francs, okay, is also is always with a forward. Okay, you see. So the Swiss franc always a forward, and sometimes for the dollar nothing. Okay, but it's not the strategy A. It's not do nothing for the dollar and for the Swiss franc. No, the Swiss franc. You have a forward for the Swiss franc. No different strategies. One strategy for the Swiss franc, forward, and different strategies for the dollar. Okay? So it's not do nothing also for the Swiss franc. No, it's do nothing for the dollar and forward for the Swiss franc. Okay? So for the Swiss franc, it's 5 times the same strategy, forward. Okay? There's only a different strategy for the dollar.
So it's 10,000.
So if we take 7K, it's K for 0.3, we have a gain. Yeah, let's go. That's 5,000. Sale 15, right? That's the end. And then T2.
Oh, okay. Well, just like that?
That's the profit.
I think
4,000 divided by 3 rounds. Yeah, so it's
Then we are fine. So assume that this is correct.
10,000 divided
Dus again, remember, if it's a forward, no flexibility, okay? The spot rate at D2 can be everything, but it's fixed.
How much? 5,000
Forward, there's only 75% of the but when we arrived over here, it was 1 to 1. So the rough, if we deep it forward, we keep guaranteed that we will have the east. How would this
Exercise price, okay, that's what.
It's 25, yeah, it's 25. Yeah.
So, for the spot rate, how
When we arrived there, it was €1 to buy. So they had to pay 5 cents per dollar.
because it's better to have $1 spot rate rather than.
Then over here, this 10,000, we got 25 cents benefit. So each one. Yeah. Like,
This is just two assumptions about the level of spot rate.
You have to buy $1.
No, I really like it.
If you don't have this, you buy every dollar.
Okay. I thought that you were trying to hear maybe faster or something like because that is exclusive.
This contract, you can buy it. You can buy $1. If you don't have it, you go to the market. You have to pay $1. Yeah, you exercise.
Always forward rate. So, spot rate at T2 can be high or low. Again, you fix at T0, you fix the rate, forward rate, and it's always at forward rate. So again, that's the meaning of
And we pay, we
always the same.
0.6, right? 0.8.
Yeah.
So, say 1,000 plus the premium price. 8,000.
What's this? That seems to rise along, yes.
And we have the exercise price of 80, and we have so here we have
Again, T0 is doing both of them, but if you are at the spot rate where you exercise the call, then because the reasoning that you must, so if you exercise the call, is then that the buyer of the put is the buyer of the put going to exercise so it means that the buyer of the put going to exercise the put. Yeah, so again, what's then the result at T2? You of course you have the premium at T0, and then the question, so if you use the call, the other one is not going to use the put.
okay, and then we stay
But we still pay the 10 in the
yeah, but we pay the
yeah, then I think look to then I forgot again 10,600.
yes.
Maximum. You see the point? It's not and because yes, if you buy, it's an option, you pay what you sell.
We have the other exercise compromise is we have the euro. We have the
So you try to 40
Yeah, I agree.
Why is it expired?
Oh, yeah, okay. Again, it's the logic is that again, if you because that's the if you ask participation coefficient of only 50%, okay, then of course you guarantee this is going to be lower. So it's a trade-off. If you ask more, because again, that's what we deduct from the guaranteed rate. Okay, and again, if you multiply it by 0.5, it's less than and that makes a difference because again, the guaranteed rate is more than the forward rate, and that's again what you pay to get that flexibility. But if you have a participation coefficient of 100, then you want more flexibility than only 50%, and then you see that in the fact that your guaranteed rate is going to be higher compared to the participation. high flexibility. Again, there is if you only ask 20%, less flexibility. And ladies and gentlemen, Peru is waiting for your answer. You have a question. No questions? Yeah, so yeah, the white is all the defense. No, it's a 6 premium for the gold, all, yeah, for the entire. Again, all your health strategies, the objective is that you don't reduce the complacency, that you do something so that
This project was the first option that I yeah. And then the second part is 060. You don't. It's you don't. Okay, so you don't exercise. So it's 500. 5,400. Yeah, no. You are receiving that money. Obligation to buy. So here is the buy.
Because I'm not going to use it, it's much cheaper, right? So I will use it not use it right now. But I have paid before the 600. I will put 300. No, these would be the
Yes, this was more confusing for us. So, in this part, we know at the spot rate 1, the exercise is so we have to pay 8,000. But here, so here do we have the option to exercise that?
No,
We
to
have
sell
the
your
obligation.
obligation.
So it's the other one that has the option, but
So,
because it's
so the,
lower,
the question that you must ask yourself is, if the spot rate is 1-1, is the buyer of the put going to use the right to sell at 50 euro cents? If the dollar is 1 euro and you have the right to sell the dollar, are you going to do that? If at the market, if the spot rate is 1-1, are you going to sell the right to sell it at 50 euro cents? No, because you can better to sell it at 1. Okay, so it means the buyer is not going to exercise. But remember, okay, yeah, so because again at T0 you decided to do both, okay? So you have you are the buyer of the call and a seller of a put. So it's both in your portfolio. So it's not so. And let's have a look at T. No. You decided at T0 to combine those two strategies. So it means paying a premium but also receiving one. And then we look at T2, which of the two options are going to be exercised, yes or no.
so in this one, the other guy is not going to exercise.
But you would.
Yeah, but again, not if you are the seller. If you are the seller, you must accept the decision of the buyer. But of course, as a seller, by just reasoning, you know if the buyer is going to use the put, yes or no. So it's not that, of course, it's the other one is okay, but again, normally the other one is making the reasoning that I have the right to sell for 50 euro cents, but at that moment, on your page, the dollar is 1 euro. Sell it for 50 euro cents, you use the right to sell the dollar for 50 euro cents, you sell it in exchange for 1 yen, so you have no difficulty. Also, as a seller, you know, if the buyer is going to rational buyer.
This is what you have to sell and he has to buy. Both buy. You don't know if you're going to sell or not, but you would like to sell if he exercises. When he exercises, yes, if he will exercise, he will benefit from the exercising. He is buying a truck and buying it from cheaper.
For the participation. No, because it's about the participating forward, huh? Okay, and how do you get 70? But that's not really a minimum, because the minimum can be if the spot rate is less than third, so it's going down. So it's not that the minimum is always here, given the two spot rates, you have 70 euro cents, but if the spot rate is not 30, but for instance only 10 euro cents, then you pay less.
He will buy it. He will buy it. He will buy it. It's cheaper to be
is that correct? No, because what you can ask, you also have a range. Tell me what is the range? What's the range? For the participating, for the maximum you never pay more than 85, and you never pay less than. Yeah, and how much? Given the numbers there, what's the minimum? Yeah, no, but so in general, what is in general here the range? The maximum is 85. The minimum is. Yeah, no, but I mean that. So in the assumption, so the spot rate can never be less than 0. Okay. So if this is 0, okay, you have 85 minus 45. So it can never be less than 40. You agree? Because the spot rate can never be less than 0. You see the point? Yeah. Everyone has the results?
So we will not because it's going lower because of the price of the so if I put the minimum we can go lower because we have so in that case it's 0.3. Our limit here and then what I will put is 0.5 so you are 1,000
Okay, so wait. I wait.
Is everybody done?
No.
yeah. Well, no, when he's
Yeah, but I mean, you have the obligation to start with someone, and he has the obligation to buy. He has the right to buy. So you will be exercised or not. Yeah,
But remember,
when he said that's the law that is below this year. And then instead the other we have
okay, we are still confused.
You are still confused.
And again, this.
okay, we need to think what is the other guy doing, right? But if he has the opportunity to buy 0.0950, which is lower than
No. The buyer has the right not to buy, but to sell.
okay, he's selling us for, so minus the higher rate. Okay.
The selling.
So the buyers here have the right to sell.
And PC is one because it's set to 100%.
The other part.
Yeah.
Yeah, you have a variation. So let's and then you have
'cause the right to sell, then he will sell at a higher price and will not exercise.
has the right to sell for us.
Not for us.
To us.
Just when you have a contact one,
0.85 minus 0.15. And then you have 0.7.
there's another guy who has the right. When you have a chance, then you have the right. The buyer has the right. Yeah, the buyer. The buyer defines that he will.
So this case, the buyer has the right to sell.
So that was you are the 115, so
To sell at a higher rate than so he has to pay.
Anyway.
So here, 6%. No, he doesn't. No, 6.8. He doesn't. He prefers policy. Not 0.8.
You will.
So he doesn't say.
Yeah, and you sell it and you buy it. And you buy it and you buy it.
So here nothing happens. Here you just get 400.
Yeah, but and so this will be
400 euros. So you have to add them for the 8,600. So the total will be that you pay is 800 to 8,200. It's 800. So now you have to add the corresponding unit, which we have 8,600 minus 4,000. This is a
My son's rubber.
8,000.
all right.
That you are going to pay for the month.
How did you compare it?
Okay, it's the same as we did. So for
Here you had you added 600 euros. Here you have another.
with the MBA, we can exchange the And we also have to pay the premium, so it's 8,600. So you have to subtract what you got from listeners are.
Oh, yeah, must be.
Yeah, I will still have
I leave my house from there with my...
no, you got it. But okay, yeah, so that will be at the university. Yeah, do the video.
En dan juist laatste.
No, porque yo lo estoy viendo. Frente al final en el balance entonces tú estás pagando 8.600, pero y acá lo restas del premio que ganaste con tus sí, en realidad acá es menos y acá es más.
This is not fair.
What's not fair?
Oh, yeah, but here, yeah, I have 5, the other one is 7.
Ready?
Yeah, that's the
You're ready, my dear?
Yeah, we are not.
Ooh, impossible. Okay, so let's so you're let's do it together. So again, about the Swiss franc, there is no discussion possible because again, you sell 3,000 units, and for each unit you get 20 Swiss francs. Okay, so it means 60,000 Swiss francs. But again, there is no discussion possible, and there is a very easy and straightforward hedge. That is that you sell, because the Swiss francs are only coming in May, but you sell a forward so that at the moment that the Swiss francs are coming in, that you are sure that you can sell them for 50 euro cents. Okay? So notice again, no uncertainty, no flexibility, no cost. That's the forward rate. Okay? So it means okay?
This is 50% of the income, right?
No, it's 70%.
You got that part right?
Okay, and labor costs, also very difficult question. So for your information, of course, if you don't complain, because that's the risk. So don't complain if you have these numbers in your table that you don't get 50% of your grade. Okay,
Yeah,
so
that's what I was going to ask. Are you going to grade it by line or by column?
No, only by bottom line. So then again, don't ask 50% of the grades just because you have 50% of the numbers. Okay, so but now. So that's another 10%. So now strategy A, do nothing. Okay? So that's very simple, because if you go back to do nothing, what's then the cost of the dollar at T1? It's of course based on the spot rate at T1. Okay? So if you are then at T2, you need to buy $10,000, okay? But there was no hedge, then you need to buy at the spot rate, okay? So minus 10, okay? And it means, so $15, okay? 15, 1, 5. Okay? And of course, if the spot rate is not 1 but only 30 euro cents, it's even cheaper, okay? Minus 3,000, so plus plus 22. Correct? Next, B. So then you have a forward for the Swiss francs, but you also have a forward for the dollar, okay? So the forward rate at T0 is $1 is 75 euro cents, okay? So no cost, you don't need to pay a premium, but again, you always have to buy at that rate. So even if the spot rate is 1.1, okay, of course that's nice. If it's 1.1, that you can only buy at 75. So again, no flexibility, minus 75, okay? So you have, okay? But same, again, if it's only 30 euro cents, yes, no choice, okay? So you need to buy at the forward rate, okay? So minus 7.5, so 17,500, okay?
In option A, do nothing. In the exchange rate, instead of less, it's more. Can you choose? Sorry, in option B, can you choose? Instead of doing hedge, go unchanged it as exchange rate as easier.
No, because again, you decided, okay? You decided to, you decided to buy the forward, okay, at T0. So it means you have the obligation, okay? You must buy from someone. So, yeah, it's also no choice. Yeah? Of course, if, of course, here you have the obligation to buy them at 7,500, okay? So someone else must sell them to you for 7,500. if you tell for that spot rate, if you tell normally you must sell them to me for 7,500, but because it's you, I pay you 10,000. Okay, that's not going to be a problem. Okay, but that's not very rational. But here again, someone else must. You must buy them for 7,500. If you tell the other one, yes, but can you not do it for 3,000? Okay, again, normally he or she is not going to accept. So that's the obligation. Okay, no. So you, in fact, that's risk management. At T0, you know exactly the price of your dollars. Okay. The rate at T2 is not important anymore. Okay, so it's an obligation. Okay, everything clear so far, Mr. President?
Yes, sir.
Very good. Strategy 3. Okay, so full flexibility. But here at the full flexibility is that you have the right, not the obligation, to buy at 80 euro cents, okay? And for that you need to pay 600 euro, okay? The 600 euro, of course, it's for the whole call option, okay? So, if the dollar, remember, maximum that you pay is exercise price of the call plus option premium. The minimum is the option premium. Again, if the spot rate is 0. If the dollar is 1 euro, are you going to exercise the call?
Yes.
But I'm waiting a yes.
Yes.
So the ladies are also saying yes. So then it's yes. So if you have the right to buy for 80 euro cents, again, you are not going to buy it for 1 euro. So you exercise the call. It means you can buy for 8,000 plus the premium. Okay, so total cost of the total cost of the dollar 8,600. So profits 16,400. But if of course, if the spot rate is only 30 euro cents, you are not going to use the right to buy it at 80. So you don't exercise, but again, even if you don't exercise, you need to pay the premium. Okay, so it means that you can buy the $10,000 for 30 euro cents each, but plus the premium, so the total cost is 3,600. Okay. Results. Okay, 21,400. Yeah, again, it's not just, so I am not asking you here the result of the call. That's not the question. It's the cost of the dollar. And again, you need $10,000, and you are going to buy the dollar at the spot rate because you don't use the call, okay? But of course, you paid 600 for the call, but you don't use the call. So the total cost of the dollar is you buy 10,000 at the spot rate, so 3,000 plus the premium that you paid for the call, but the call that you don't use. You see the point? So here the question is, if the question is, what is the result, okay, of the call at T2, then the message is, I don't use the call, I paid 600, so for the call is minus 600, okay? But here the question is, what is the cost of the dollar? And again, the cost of the dollar is that you buy them at the spot rate, you don't use the call, plus the option premium, 3,600. You see the point? And you understand? Where 3,600 is coming from? So,
I know 600.
sorry?
But where the 3,000 from? So we can plus 3,600.
He understand the same meaning. It means we just know about 600,000. We don't know where is the 3,000.
Yeah, but the 3,000 is because, again, this is at T2, this is at T2 the spot rate, okay? Again, I'm not going to, because based on the call, I can buy the dollar for 80 euro cents, okay? But again, on the market, I can buy it for 30 euro cents, okay? So first part is, I buy $10,000, because again, this is not the result of the option, this is the commodity cost. I need at T2, I need $10,000. Or I can receive the dollars by exercising the call, but because that's more expensive, I don't exercise the call. I just buy the $10,000 that I need to pay to the supplier. I buy it on the market for 30. So that's why I have 3,000, but the 600, because I decided to hedge, to buy a call. Again, I don't use the call, but I paid for the premium. So again, the 600 is the payment of the premium, plus the 3,000, it is the cost of the $10,000, but at the spot rate. And so then I can pay the supplier of the commodities. Clear? Okay, next. So now we are in D, and there we have a range forward. Again, remember, at T0, you buy a call and, you buy and you sell a put, okay? And for the call, because it's the same call as in C, you pay 600, but because you sell the put, you receive 200. So the net, so at T0, the net cost of doing both is, the net cost is 400. 600 minus 200, okay? No, that's not correct. 600 minus 400, okay? So the net cost is 200. Okay, so, and then we move to T2, and then the dollar is 1 euro. Again, you are the buyer of the call, so you have the right to buy at 80 euro cent. Someone else has the right to sell the dollar to you for 50 euro cents. First of all, if the dollar is 1-1, is the buyer of the put going to exercise the put? No, because if he exercises the put, he needs to sell dollars to you for 50 euro cent, and he can sell it on the market for 1 euro. Okay? So at 1-1, the put is not exercised. Okay? So we can, but the call, you can exercise the call. Are you going to exercise the call? Yes, because then you can just buy the dollar for 80 euro cents. So you exercise the call. So it means you pay 10,000, you buy $10,000 for 80 euro cents, 8,000 euro, okay? The net cost of the two, it's 200. So the $10,000 is 8,200, okay? And of course then, Okay? It's okay. So, if the dollar is 30 euro cents, again, are you going to exercise the call? No, because you have the right to buy them for 80 euro cents, but they are only 30 euro cents. Okay, so you don't exercise the call. But small problem, someone else can sell them to you for 50 euro cents on the market. He or she can only sell it for 30 euro cents. So the buyer of the put is going to exercise the put. So it means you have the obligation to buy dollars from the buyer for the exercise price of the put, 50 euro cents. So it means you buy then $10,000 for 5,000 euro plus the net cost of the strategy. Okay, so the okay, so you have a profit of
1980.
okay. Sorry.
Based on that, did we choose this 8,200 in the first scenario, and based on that, we choose this 5,200 in the second scenario? Because I saw that we should risk a rate.
Sorry?
I saw that in most options we should use a range. Okay, this should cause between.
Yeah, but this is the range, okay? So, because again, if the dollar is 1 euro, based on buying a call, you can buy them for 80 euro cents. Okay? And the buyer of the put is not going to exercise the put. Okay? So, remember, cost of the dollar, maximum is the exercise price of the call. Exercise price of the call is 8,000 for $10,000 plus the premium of the call, 8,600, minus the premium of the put, minus 4, 8,200. What's the minimum? The minimum is the exercise price of the put, 5,000, okay, plus the same, the 200, 5,000. So that's the range. Because again, if the spot rate is only 30 euro cents, the buyer of the put, because again, if the buyer of the put is selling the dollars on the market, he can only sell it for 30 euro cents. But you have the obligation to buy them for 50 euro cents. So he's going to tell you, yes, my friend, but based on the put, you have the obligation to pay me 50 euro cents, okay? So please give me 50 euro cents. So it means that you need to pay for $10,000, 5,000 euro, plus the cost of your strategy, 200. You see? Then everything clear so far? Then the final strategy. So, participating forward, it means you never pay more than 85 euro cents, okay? So it means if the dollar is 1 euro, so again, you pay only 85, okay? So, okay? So, conclusion. Okay, 16,500. If it's going down, and if it's going under the central rate, then we decrease the guaranteed rate. Here, at 30 euro cents, that's clearly under the central rate, okay? How much are you going to pay? 85 is the guaranteed rate. Participation coefficient, 100%, so it's 1. And here you have central rate minus the spot rate. So it is, okay, so again, you don't pay the 85, a little bit less. How much? 0.7, okay? Coming from 0.85, the guaranteed rate, minus participation coefficient 1, multiplied by the central rate, minus the spot rate, okay? So 0.70. So here we have 7.
Because you have to calculate the. Okay, so you're right.
So, is this clear? Is this you are going to do nothing? No? Ah, okay. Is this so quick question. So quick question. So because again it's not a question of doing the calculations, it's a question of feeling, okay? So you must feel if you use a certain, because again, it's not that you can decide this is the best strategy, okay? It's also a question of sophistication. If you are in a very simple company, then we use simple instruments. And what's a simple instrument? That's a forward, okay? No surprise. But if you are a little bit more sophisticated, then you go more to options, flexibility, okay? But then you need to a little bit sophisticated because, of course, you need to pay a premium and so on. So it's better than to have a certain level of sophistication. So it's not a question of this is the best strategy, okay? It depends on your level of sophistication, okay? But, so it's not just a question of doing the calculations, but you must have a feeling for if you use that strategy, what's going to be the result, okay? So, my question to you is, so for this one, you have only 1 minute, and the question is, what's going to be the profit, okay, if all the rest the same. The only thing that I am changing is, so not 1,1, but 120. And here, not 0.3, but
1 minute.
yes. So again, all the other rates the same. I just changed the assumption about the level of the spot rate at 2T. All the rest the same. Okay? So normally you must be, if you have a feeling for the meaning of the strategies, you must be able to do this in 15 seconds. So and you get 1 minute, so you can do it 4 times. Okay?
I was just multiplied by 20%.
So just
20%.
No, just put it. So again, 1.20 and here 0.10. That's the only change. Where are you going to? Right, that's the message. That's understanding, okay? Because of course, if you just copy the results of this exercise, that's not understanding. So you must understand what the result is of a strategy.
So the examination, the same?
Maybe yes, maybe no.
You should say yes because we're very happy to hear that.
So how long is 1 minute in Colombia? Almost there.
Yeah, so most of them
The first one we can do the microwave. Depends on which one you
Sorry there. You have the results? Your bonus is still based on your number of the interception. You have the result? Ready? Ladies, you have the results? Because you're here, we are taking.
I'm on the other side. Yeah, but the other side.
Yes, it gives the impression that it's a secret camera at the back, so it's. Your boss asked us to do this to check if you're always in the room, that you're not lying in the sun. Okay, ladies and gentlemen. Again, the message is, again, that you must have a feeling for the type of strategy that you are using. Again, of course, remember, if you do nothing, you are at risk. You have the full risk, so it's not possible that it's going to be the same. Okay? So if the dollar is 1.20, you don't pay 10,000, but you pay 12, and so the profit is going down. Okay, and the new profit is 13, okay? But of course, if you are at risk and it's going in the right direction for you, so it's the dollar is becoming cheaper, then of course you make a profit, because here you only pay. So your profit is going up to 24, okay? That's straightforward, I hope. Okay? So, remember, second strategy, forward. So, no flexibility, okay? You always need to buy at the forward rate, okay? So, if you buy a forward, or if you sell a forward, okay, In fact, what you are doing, you exclude, okay, the importance of the level of the spot rate at T2, okay? Always the same cost for your dollars. So if I don't change the forward rate, I just change the assumptions about the spot rate at T2, so that's not going to influence your result, okay? So it means, so the same 17,500, 17,500, okay? Okay? Next, the option. Always the same? So again, option, it means if it goes up, you are hedged, okay? But of course, flexibility, if it becomes cheaper, okay, you pay less. So here, 8,600, so profit stays at. But here, of course, you only pay because you don't exercise the call, so you just pay the 10,000 at 10 euro cents, okay? So it's 1,000 plus, of course, the premium. So the profit is going up to 23,400, okay? Next, the range forward. Is there going to change something? No, because there, again, you have a range, not more and not less. And the problem is that if it's going up, you use the call option. Okay, so no change here. But also, if it goes down, problem, you promised someone, you always pay at least 50. If it's only 30 euro cents, you need to pay 50. If it goes down to 10 euro cents, the buyer of the put is still going to exercise, so you still need to pay 50 euro cents. So also no change here. So 19,800. Okay. Of course, because it's going up, but again, in the participating forward, you are hedged at the guaranteed rate, okay? Not more than, so we have 16,500, but if it goes down, also the cost is going down, because now you have 85 minus 1 multiplied by 45 minus 10. So now you have minus 30. So now the cost is going from 0.7 to 0.5, okay? Okay, so this is minus 5. So this is going up to plus 20. At your service. Is this clear? So you see that the message is, it's not a question of doing the calculations. So it's a question of, from the moment that you have a feeling, what does it mean buying a call and selling a put? So you have a range, okay? Again, if you have then a higher or a lower, you have the range, so you know immediately that the result is, for instance, going to be the same, okay? And so on. So that's...
How many questions on the exam?
Are between 200 and 300.
The first one, right?
No, the first one is the meaning of the Amstel Gold Race.
Not the meaning of life. We have the number for that one.
Okay, so it's a little bit too late for a coffee, President. Let's go on.
I have it. Yeah, we're supposed to.
You have a-
I have to see my supervisor at 4, so.
Ah, okay, so you can leave.
No, yeah, that's cool.
But let's just go. I still need to discuss one thing today, okay? Because again, I promised you that everything for the exam, okay? It's only based on what we discuss up to today, okay? So and because I know the exam questions, I know that we still have to discuss one thing. Okay? So is it a problem if we go on? Okay. Okay, so so it takes then another 40 minutes and we can start, because if we take 20 minutes break, then we can only finish at 5. Okay, so let's go on and we can finish around 4:30. So is this clear? Okay.
It needs time to capture it properly.
Sorry?
It needs time to absorb it.
Ah, yeah, okay, but you have plenty of time this night. Huh? Okay, so next. No, we go on and then we can finish around. You will see it's not very complicated, but I just want to make sure that we do it today. Because about what we are going to discuss right now, normally you already need to know it, okay? If you remember something from financial management. So, again, introduction. That was last week. So now we finished financial risk management. Of course, we can go on for days, but and someone asked me what to read. Again, it's very simple. Okay, so for financial risk management, you chapter 5, okay, and chapter 11, because in chapter 11 you have about managing transaction exposure. And so you have the money market hedge, the currency option hedge, the forward hedge. Again, that's what we discussed, okay? So 5 and 11. Again, the chapters like 10 and 12. 12 is about 12 is about translation risk, okay? But again, we only discussed the definition of translation risk, okay? So if you are interested in knowing more about translation risk, just do 12. But again, if it's just because most of the companies, they are just managing transaction risks, okay, not translation risk. But if you are interested in translation risk, so but again, 5 and 11. But again, if you understand what we did in class, okay, so if you are completely confused by the case, okay, of 2 minutes ago, then you need to do some more reading, okay? If you this morning, if it's completely buying a call, why is it like that, okay? I don't understand. Yeah, then you need to read chapter 5. But if, based on our discussion, you know that it's completely clear why buying a call is that, okay? Yeah, okay, then it's under control. You see the point? So it was yours. Okay, so now.
So we need only these 2 chapters.
Yes.
Guys.
Yes. So of course, there is always a difference in life between need to know and nice to know. Okay, so there are a lot of interesting things in the book, but again, the big problem is if I can cover, of course, much more chapters, but if I just give you the presentation and I tell you the derivatives in currency, options, forwards, and I don't explain them, okay? So let's go on with the next chapter. Then, okay, so then you know a lot of chapters, but you know nothing about a lot of chapters. It's better to know something about 2 chapters than nothing about 10 chapters, okay? So, okay, so now we are going to discuss valuation of companies, okay? And the first thing, but again, first thing, the cash flows in finance, okay? Remember, most of this story is well known by some of you because it's the same story as for. Yeah, so, and it was in which chapter? Oh, that's which chapter in financial management? Yeah, well, yes, every time. No, but give me the topic, that's better.
Oh, yeah, of course.
Yes.
There's cash flow.
Yeah,
The
but,
red method and the red method were...
yeah, but you needed to use the cash flow. In which topic? Yeah, the cash flow in the table and the table. And the table is in the kitchen or something. So we needed the cash flow for the table in the kitchen. And which table? For the net present value. You remember? Okay. Okay, so and let's do it based on some numbers. Okay, that's easier to. Please. Good. It's 2 times the same, so you have to give 1 to your neighbor. That's the.
Is there a question?
What?
Is there a question?
Yes. What were you going to do?
I wanted another copy of the previous case.
Ah,
Do you mind if I take this one?
Oh,
Can I take this one?
no, not that one. I give you another one. Please. And please. Just take this one.
This one?
Yes, that's it. Okay, so just remember, first important remark, that is, but I told you already for financial management, that is, don't be confused, okay? Because if you discuss cash flows, also in accounting, okay, the definitions are not always the same in finance and in accounting, okay? What can be included in the different cash flows in accounting, okay? Cannot, based on international reporting standards, cannot always be included if it's a cash flow in finance, because if you include it in finance, okay, and then you use it for an MPV calculation, then sometimes some items are included twice, okay, or not included. So don't be confused, okay. Don't think that if the discussion in accounting is different from the discussion in finance, that's one of the two is wrong, because again, some things are allowed in accounting, but it's not because it's allowed in accounting that you can do it in the same way in finance, because if you do it in the same way in finance, your calculation is not correct. Okay? So that's a small problem. So, again, and then on Thursday I tell you where you can use the different cash flows if it's about evaluation. But again, you see, what do you need to calculate? Operational cash flow and the free cash flow to the firm. Question 3, we are not going to discuss that. That's about your neighbor. But we just want to calculate operational cash flow, free cash flow to the firm, and free cash flow to equity. Okay? Okay? Your supervisor is waiting. Okay, so how do we start? Okay, the calculation of the operational cash flow, the free cash flow to the firm, and the free cash flow to equity. What to include and what not to include. Okay, of course, if you look to the numbers, we start with the So we start with the revenue minus, so revenue is so 314, so minus the operational costs, and we can take the operational cost and the operational overhead, we can take them together. Again, it's all operational, okay? Operational cost, again I take it together, that's minus 209. Sorry? Minus. It's a real gentleman. See you Thursday. Yeah. So, again, revenue minus operational costs is the so-called okay? EBITDA, so it means it is okay? You still agree? So now you need to deduct so depreciation, amortization minus 38. So this is 67,000, and so this is the EBIT, okay? So again, the first thing that we want to calculate, it's operational cash flow and so on, okay? So remember, because again, I'm just if something is not clear, you need to go back to your notes from financial management. Or you still have to do your notes, or they already? Yes? Somewhere. So again, remember, if you calculate in finance, two important principles. if you go to the operational cash flow, principle 1, never deduct depreciation, but I did it. So that's not. Never deduct. Yeah, or in general, never deduct funding cost. Because remember, also in the valuation of companies, we are going to discount, okay? And it is by discounting that you eliminate the funding costs, okay? So don't do it already in the calculation of the cash flow. Otherwise, you eliminate the funding cost twice, okay? So never, but remember, based on accounting standards, if you calculate the operational cash flow for a nice table in your financial report, okay, so based on some reporting standards, you can deduct interest payments in order to calculate the operational cash flow. Okay? So sometimes you can do it in accounting, but again, if you do it also in finance, and then you use that cash flow to discount at the weighted average cost of capital, we have a problem. Okay? So never deduct a funding cost if it's finance. Principle 2.
Exclude tax advantage.
You have your exclude tax advantage from from exclude the tax advantage from interest payments, okay? So it means you don't deduct interest, dividends, you deduct taxes, but you deduct which taxes? You deduct the so you deduct the operational taxes. It means the taxes on your operational results, okay? Because again, you don't pay taxes. At the end of the day, you don't pay taxes on EBIT. You pay taxes on your taxable income, and your taxable income, it's EBIT minus interest payments, okay? But again, for the operational cash flow, you deduct operational taxes. It means the taxes on your EBIT, interest payments excluded, and again, if you calculate your operational taxes, the tax advantage from interest payments are also excluded. Okay? So here, because it's given that your tax rate is 50%, okay? So it is, so it's 50, yeah? So it's, okay? Okay. Do you still remember the name of this? This is the famous okay? Earnings before interest after operational taxes. And that's a homemade concept found by myself. Okay? So I go on here. Earnings before interest after operational taxes. Again. Next step. So we add back depreciation and amortization. Okay? Because depreciation is not a cash flow in that period, but it's going to influence your taxes. Okay? So that's the reason why we need to deduct, but then later on we need to add it again. So we add again depreciation and amortization. So that's plus 38. Is this the operational cash flow? The answer is The answer is, if you go back to your secret notes.
No.
No, and what do we need to add?
Working capital requirement.
Sorry?
Working capital requirement.
So, but remember working capital requirements? So, change in working capital requirement or working capital needs, okay? But here we need a minus, because a positive change, if you have a positive change in working capital requirement, it means that this is an overestimation, okay, of the cash flow, so we must deduct. If it's a negative change, so then it's an underestimation, and you have minus, it's a plus, okay? So, so please, if this, so minus change in working capital requirement, and here it's a change in inventory, it's minus, so it means a decrease, okay? So we have plus, because again it's minus 13,000. So conclusion, the operational cash flow here is $84,500. Okay? You still agree? So again, a positive change in working capital requirement, it means that this is an overestimation of your cash flow, operational cash flow. That's the reason why we need to deduct, okay? Now we need to go from the operational cash flow to the free cash flow to the firm. Because again, operational cash flow, it means the cash flow available coming from your operations, okay? So what's now available? You have operations in a period, and what's now the cash flow left from your operations after paying all your operational costs and so on, okay? So with the operational cash flow, you can do two things. First, what you can do with the operational cash flow is to invest in new assets, okay? And after investing part of the operational cash flow, then there is still cash flow left, and that's the cash flow that we can distribute to equity and debt holders. Because again, so far there was no compensation of your equity and debt holders. So we still have to do it, okay? But first, okay, we from the operational cash flow, we deduct new investments. Tell me, where are the specialists in accounting in the room? How much, what's the number of new investments if you read the text? What's the number of new, the number? 8,000. Other specialists in the room?
8,000.
Oh, how much?
8,000.
8,000. Other specialists in the room? Where are the people with accounting backgrounds? You? No. She told us. No? Because it's not 8,000, but because again, what is the amount? What is the amount that we have at the beginning of the year? Okay, but again, you have 145, but we have 38,000 depreciation, okay? So it means if there are no new investments, we have 107,000 at the end of the year, because we have a depreciation of 38, but at the end of the year we don't have, we have 153. But again, only based on depreciation of 38, normally you have 107 at the end of the year. How is it possible that you have 153? Yes, that's because we have 46,000 new investments. So it's not just the difference between the 145 and 153, because again, normally you have depreciation, and without new investments you end up with 107. Because you have 46,000 new investments, you have 153. Okay, so the new investments is okay, and remember, so we have here okay, and the 38,500, that is the so this is the free cash flow to the firm, okay? And again, the free cash flow to the firm, it means the cash flow available to distribute to the equity and the debt holders, okay? Because again, you have operational cash flow. Part of the operational cash flow, you're going to use that for... Oh. And so part of the cash flow, we are going to use that for doing new investments, and the cash flow left, that's the cash flow that we can distribute to equity and debt holders, okay? So that's the meaning of free cash flow to the firm. For your information, I included also here minus the change in working capital requirement. Remember, because it's possible that you include it just before calculating the operational cash flow, but it's also possible that you only include it after the calculation of the operational cash flow. When do you need to include it here? And when do you need to include it there?
If it's a positive.
No. Because operational cash flow, it means what is the cash flow coming from your current operations, okay? So what is possible? It's possible that based on my current operations, I increase the level of my inventory, or I decrease it. Then, of course, if it's related to my current operations, then it's part of my operational cash flow. But it's also possible that I'm going to do new investments, and because I'm doing a new investment, I need an additional inventory. But that additional inventory, it has nothing to do with my current operations. I start a new business, I have new investments, and I need fixed assets, but I also need an additional inventory. If it's related, everything of your working capital requirement, if it's related to new investments, then of course you need to include it here. If it's related to your existing operations, then you need to include it at this level. And that's the reason why you have here between brackets based on current operations. Okay, so you decrease change in inventory. If it's a minus, it means a decrease in inventory. It's a decrease in inventory based on your current operations. So it's going to give additional operational cash flow, okay? But again, if you build up a new inventory which has nothing to do with your current operations, but is related to your new business, new investments, again, then it's not correct that your operational cash flow of your operations today is influenced because you use money to build a new inventory for new investments, again, investments that have nothing to do with your current operations. So you see the point? Because in some books, you have change in working capital requirement at that level, sometimes you have it at this level, and then students are confused, okay? Do we need to include it here, or do we need to include it there, okay? Again, the two are correct, okay? But the key question is the change in working capital requirement related to your current operations? If the answer is yes, then you need to include it here, okay? If it's not related to your current operations, but related to something new that you're doing in your company, you need to include it here, okay? But again, here it's clearly mentioned that it's current operations, so you need to include it here, okay? So here, for this exercise, there, that is nothing, okay? Is that clear? So the question is, so it's not it's not black-white, okay? It's not always here, not always there. Both are possible, okay? So, okay? So the free cash flow to the firm, again, the free cash flow to the firm, it's the cash flow available for an equity to distribute to equity and debt holders, okay? And then, if we start again at this level, okay? So, now we are going to distribute the cash flow. Again, you still need to compensate the people funding your company. So the first group that is normally receiving money from you, that are the so the debt holders, okay? So the first, so you pay interest. And the interest in this story is remember, because here we included operational taxes, but at the end of the day, you don't pay 33,500 to the tax administration, you pay less, because you only pay taxes on your taxable income, you don't pay taxes on your EBIT, okay? Again, you have a tax advantage on interest payments. So somewhere in the calculation, you must take into account that you make a tax advantage with interest payments. And that is if you go from the free cash flow to the firm to the free cash flow to equity. Okay? And how much is it? The tax, because you pay 24,900. That are the interest payments. The tax rate is 50%, so the tax advantage is. Yeah. So it's in the again in the step from free cash flow to the firm to free cash flow to equity. In that step, you need to include the tax advantage coming from interest payments, and this is. No, this is not correct. Okay, so the free cash flow to equity, it is 38,500 minus 24,900 plus, because that's a positive, of course, or tax advantage. So the free cash flow to equity is 26,050, okay? It means, again, the cash flow available for equity and debt holders is 38,500. From the 38,500, first you give something to the debt holders, 24,900. But because you give 24,900 to the debt holders, you make a tax advantage, and that tax advantage is also available for the equity holders. So what is the meaning of the free cash flow to equity, the 2650? That is the amount, the cash flow available for equity holders. Okay, so the free cash flow to the firm is available for equity and debt holders. You first give something to the debt holders, and what is left, the 2650, that's the free cash flow to equity, that's available for equity holders. Okay, and then just the bottom line, because then you pay dividends. Okay, 5,000, if I remember well. So, because again, it's not because 26 is available that you also distribute 26, okay? No, you only distribute 5,000. That are your dividend payments. So, this is the net cash flow, okay? So that's the cash flow that is left in the company, okay? So again, the different steps are operational, okay? So what is the cash that you, the cash available based on your operations? Again, the operational cash flow, you can use it for doing new investments, okay? What is left, that's what you can give away to equity and debt holders. The first group that you are going to compensate, that's the group of the debt holders, interest payments. But because you pay interest, you make a tax advantage. So this amount is available to distribute to the equity holders, but you only pay the dividends to them. So what is left, that's the cash flow that stays in the company, and that's the net cash flow. Okay? And so the message is, but that's what we are going to do on Thursday, if in calculations we only use the net cash, if we only use the net cash flow in the calculations, okay, then it's not important if you deduct something at this level or at that level. Because you only use, but what's the problem in the valuation of companies? It's not that we just use the bottom line. We use the free cash flow to the firm sometimes, and sometimes we use the free cash flow to equity. So that's the reason why it is important, because again, if you include already this amount in the tax payment and you decrease the tax payment, then of course your operational cash flow is going up and your free cash flow to the firm is also going up, okay? And again, in some calculations, we need to use the free cash flow to the firm. So it's important that we don't include already the 20 of the 12 in this amount, but that we only do it if we go from the free cash flow to the firm to the free cash flow to equity. Otherwise, it's included here, okay? And we use a wrong amount to do our calculations. You see the point? So again, up to the operational, so if it's going a little bit too fast, okay, but up to the operational cash flow, again, you have the same principles. So if that's is not on your hard disk anymore, go to the big small book of your colleague, because that are the principles that we discussed already. If we discuss the calculation of the operational cash flow that you need to use in the MPV calculation, okay? So the additional steps are just these steps, okay? So that was discussed also in finance, okay? These are just the additional steps, okay? So very simple. Is that clear? So these are the principles in the calculation of operational cash flow, free cash flow to the firm, and free cash flow to equity. Okay? And again, the reason why I discussed it today is because we agreed that now it stops for everything what you could expect as exam question. On Thursday, again, we need to go on, but that's not part of the exam. But up to now, that's part of the exam. So it's not very difficult to have a feeling for a potential exam question. Well, so again, if you have questions about this, okay, just ask me Thursday morning. But again, the message is so this is still included in need to know, okay? Not nice to know. This is need to know. And again, Thursday we go on then with the rest of the techniques, evaluation techniques for companies. Okay? So remember,
How many questions?
so, but there was some influence on Karen, and you know that you only need to hand in it on Tuesday morning, Yes. Okay, so the paper for Tuesday morning, exam for Friday, okay? Questions, ladies and gentlemen? No questions? No? Ooh. But yes, but that's a surprise question, okay? So let's do it on Thursday, okay? So ask it again Thursday morning.
Thursday morning?
Yes?
Examination?
No. Yes, for your information, Thursday we have a class, huh? So she is very soon. Sorry? Yeah.
I just have Friday for exam.
So on Friday you have the exam, but on Thursday, no, class. So because again, last week, okay, normally there was a class on Wednesday, but again, we postponed the class of last Wednesday to next. Is it not yet on Moodle?
No, she sent an email.
Yeah, okay, so you know, you are aware. So